I don't think people are missing financial literacy. I think we're just missing access to this information. And the problem is there's a lot of information out there on Google, TikTok, your uncle, like you don't know where to go for half the time. And in half the time, clients just feel overwhelmed with what to do. And they just want a clear path, what's the best way, not based on the rule of thumb, but based on my goals that are important for us. So I want to invite Darian, who I've been known for the last 5 years now. He does good work for people and clients, understand more about tax implications. So I'll be talking about more what I do as a wealth advisor, but I want to have Darian share the floor with me to walk him through about things we can do. Because I know growing up, we were taught to save money, go to school, and avoid credit card debt, but we all both know there's way more to that than just saving money. So, Darian, I'll let you introduce yourself and what you do and how you guys started, and walk us through your presentation today. And I'll kick off the last 30 minutes of our meeting today.
Okay, perfect, perfect. Well, I'm gonna share my screen then. And again, if y'all have any questions throughout the process, just shoot us a message in the chat. And then if y'all can give me the thumbs up when y'all can see my screen, that'd be perfect. All right, should be on the slides now. We're good to go now?
Yep, you got it.
Okay. Perfect, perfect. Well, yeah, like Antonio said, our goal is to teach as much as we can, but most importantly, educate our community about different ways to get creative with not only just saving money on taxes, but essentially to invest for your future. So the whole point of this presentation is to teach you all how to build wealth, but also reduce taxes at the same time. And the way I like the word is that let's reduce your taxes so that you can use your tax savings to essentially reinvest it so you can build wealth throughout the same process. So Tony already introduced himself, but me, I'm Darian Wiggs. I'm a licensed certified public accountant, and I am the founder and CEO of Wiggs CPA Tax and Accounting, which is a firm that's 100% virtual. We're based in Chicago and now the Denverland area, but we serve clients from all over the country, right? So me and Antonio both, we do have an education from the University of Illinois, IOL, Big Four. I know we got some MSU folks here. But University of Illinois is where we went. We both got a bachelor's degree and a master's degree in accountancy. So I know a lot of times you get misinformation all over the internet and web, but we actually put hundreds of hours, if not thousands of hours into our education on top of having Big Four accounting experience. And I'm really passionate about financial literacy. A big reason why I started my own firm is because I didn't feel like I would have the impact that I wanted to have on my community personally in corporate America. So I stepped away so that me and Antonio can create environments like today to essentially teach you all about taxes and building wealth. So, for starters, taxes. Tax season. Hopefully, everybody filed. If not, file an extension by April 15th and just make sure you take care of Uncle Sam so he doesn't be knocking on your door. So, the downside of taxes is the reality is the average American, depending on how much you're making, can easily be paying almost 40% of your income to taxes. When you look at it, you got federal tax, you got state tax, you got gas tax, liquor tax, tobacco tax, Social Security, Medicare, property, like it adds up. So when you do the math, if you really paying 40, 50, 60% of your income, depending on what tax bracket you in, that means the first 4 to 6 months of the year, you're technically working for free. Now, I don't know about all of y'all, but I don't mind working for free sometimes, but not 4 to 6 months every single year. So when I started doing the math, realizing that the vast majority of Americans, especially those of you making six figures, like a huge percentage of your income is going to taxes. But the beautiful thing about that is, yes, the tax code is 70,000 plus pages, but it's not 70,000 plus pages teaching you how to pay taxes. It's 70,000 plus pages of teaching you how to legally avoid taxes. But in order to do so, you got to understand the rules. So the whole point of this presentation today is essentially to teach you how to understand the rules of taxes because the wealthiest people in this country, they don't pay taxes because they understand the rules. They understand that in order to win in taxes, you need to be on the winning team. So that's what this presentation is essentially to give you all a snapshot of like how you can essentially join the winning team so that you can reduce your taxes. Because not knowing the rules of taxes can cost you thousands of dollars. I always say you wouldn't approach the game of lacrosse, Monopoly, spades, Uno. You wouldn't approach those without knowing the rules. So my question to you all is why do we continue to approach the game of money and taxes without knowing the rules? So what are the rules? Great question. Try to break this down as simple as I can because taxes can be complicated. So, rule number one is that you have to join the winning team. So, you have to realize that the tax code is not made for W-2 employees. Now, this isn't me telling you to go quit your job. This is just me letting you know it's not about how you're taxed, it's about when you're taxed. You see, as a W-2 employee, and I just went into my little piggy bank over here, you make money. You may make $100,000. But on paper, you make 100,000, the IRS takes their money and you get to spend what's left. That's how it works as a W-2 employee. But as a business owner and an investor, the tax code changes. You can make $100,000. You can make it, but the IRS doesn't tax you on 100,000. They tax you on what's left after you spend all your money on anything that's ordinary and necessary to operate your business. So if you're strategically, one, making money, but two, if you're strategically investing your money with Antonio, you're strategically buying real estate, you're strategically purchasing assets to reduce your taxable income, there won't be any money left to pay taxes on. So that's rule number one, is that you have to join the winning team. You have to understand that the tax code can be your friend, but you got to be on the right team. Rule number two is that you got to understand what a write-off is. A write-off is technically anything that's ordinary and necessary to operate your business. And the beautiful thing about that is that you get to determine what's ordinary and
Just sent the
necessary.
chat.
What was that? Ed? Oh.
Hey, Darian, quick
Mhm.
question. Are you showing your screen? Because I'm looking
Yes.
on the left side. Yeah, I don't see it. I don't
No
know.
one sees it?
No, can you redo
Okay.
that? And you don't
Yeah.
have to go through every slide, but I was kind of reading on the left. It was like, oh yeah, I think you're talking about each slide and it's not coming out.
Oh, I'm
So
glad you said something.
yeah, I'm sorry.
Yeah, no worries. Yeah, great catch because I definitely was showing some visuals there. Y'all missed it all. No, you can see it now.
Yep, we can see it now.
Okay, yeah, I definitely would never have left y'all on the first slide. So you were looking at this the whole time then, right?
Yep.
Okay, perfect. All right. Well, this is just the first slide showing that it's an actual firm here. Second slide, we're just going over some of the downside, the taxes, essentially letting you know that, hey, taxes, it may not feel like you're paying 40 to 50% of your income to taxes, but when you do the math, looking at your federal tax bracket, your state tax bracket, Medicare, Social Security, property sales, like technically the first 4 to 6 months of the year, you can be working for taxes. And then this is where I was just getting out about some of the upside to taxes. So thanks, Ed, for pointing that out. So, rule number one, joining the winning team. That's what essentially you got to do. Now, rule number two is that you got to understand what a write-off is. As I mentioned, the tax code is 70,000 plus pages, but the most important code section of it is section 162A. That is the one that says, hey, if it's ordinary and necessary to operate your business, you can write that off on your tax return. You see, as a W-2 employee, you can spend money. You can say, hey, I got this from my job, but you're not going to be able to write that off on your tax return. So the IRS incentivizes you to start a business. It incentivizes you to own real estate because you can make $100,000 there, but you get to keep the vast majority of your money, and you don't have to pay $30,000 in taxes essentially because you are being taxed a little bit differently. So my goal today is not to just talk. I want to give you all a visual example. So I got my iPad out in a second, but this is just a list of like some of my favorite write-offs personally. I always like to remind business owners, even those of you as investors, that a lot of your day-to-day expenses automatically become deductible the moment you have a business. Auto expenses, advertising, meals, health insurance, legal professionals, cell phone, internet, health insurance plans, retirement. Like there's a lot of expenses that a lot of business owners miss, especially when you do your own taxes or you don't work with a qualified tax professional. Because when you make the pivot from being paid as a W-2 employee to being paid as a business owner, a lot of times we're not educated how to go from W-2 to 1099. So, and they even teach us that as a CPA in college. Like a CPA stands for Certified Public Accountant. So it focuses more on public accounting. So once I realized that a lot of small business owners don't even know what a write-off is. So I just want to remind you that even if you don't have an LLC set up, you're legally obligated and you're required, not required, but you're eligible to take these expenses to deduct it from your taxable income. See, a lot of people think that you need an LLC to take business expenses. You don't. The moment you say, hey, I got a business, I'm a sole proprietor, or you're getting a 1099 because you're doing Uber, Lyft, or you got a rental property, you can take the same exact expenses that most business owners can take. You just have to do a good job of being more organized. So this next slide, and I'm gonna reshare my screen, and please let me know if y'all don't see an iPad in a minute. But I want to give you all like a real life example essentially of how I go about working with my clients to essentially reduce their tax bill. If anybody has questions on anything I just said, I know the slides are like halfway on there. And if not, no worries at all. Let me know if any questions come up.
Yep. And I'll keep an eye on the chat as well if they're in.
Okay, perfect. And then you can confirm and when you can see my screen, please. All right, you should be able to see it in the next 10 seconds. All right, we're good now? All
Yep, we see it now.
right, what number did I write?
5
All right,
or
cool.
less.
Just want to make sure. Just got to make sure this time. So the way it works is, and I work with a lot of business consultants. So at Wiggs CPA Tax and Accounting, we do taxes during tax time from January to April. But outside of that, we specialize in working with service-based business owners. Our logic is you provide a service to the public. We want to provide a service to you by taking over all your accounting needs so you don't have to stress about the financial aspect of your business. You could just focus on scaling and growing your business. So we work with a lot of consultants. One of our consultants, giving you all an example, his name is Kevin. So Kevin, don't mind my handwriting. Kevin makes $100,000. So if Kevin is making $100,000 in corporate America, we all know he's going to pay about 30% of that to taxes. How? Illinois, 5%. Let's just say he's in the 24% federal tax bracket. So his effective rate is about 18%. You got to pay Social Security, you got to pay Medicare. So me putting 30%, that's actually me being a little generous. So Kevin just had a $30,000 tax bill if he was a W-2 employee. But the moment Kevin said, "Hey, I'm not a W-2 employee, I actually have a 1099 NEC and I'm a business owner," it changed the entire situation. Because the moment Kevin making that same $100,000 says, "Hey, I own a business," well, it's not about how you're taxed, it's about when you're taxed. So when you're a business owner, I had that conversation with him. Okay, Kevin, well, you're a business owner. How much are you spending for your internet? How much are you spending for your phone? How much are you spending for meals, travel, your new laptop? He gave me a whole list of expenses. And when I did the math, Kevin had about $10,000 in expenses that he wasn't able to write off originally, but because he's a 1099 employee, now he get to deduct those on those tax returns. On top of that, I don't know if a lot of people know about the QBI deduction, but the QBI deduction is a qualified business deduction that you essentially get that's up to 20% of your income. Now, this was set to expire, but the Trump administration had extended it. So, business owners, if you have a business, you qualify for up to a 20% tax deduction to offset your taxable income. So, Kevin by himself got a $20,000 deduction just because he had a business. And why do business owners get a 20% deduction? It's because in 2017, the corporations had a 35% tax bracket and the Trump administration dropped it to 21%. So it's like, how do they get a huge slash in their tax bill, but we don't as small business owners? So the QBI deduction exists for that, but a lot of people miss it because they don't know that they qualify for it. So now he has a $10,000 deduction. He got the $20,000 deduction there. And then Kevin invests a lot as a consultant, as a business owner like myself, or Alva, or your real estate investors. A lot of time you invest a lot of money into your education. I personally spend $15,000 to $25,000 a year learning. But when Kevin told me, "Hey, I spent $10,000 to go to school," the first question I had to ask him was like, "Was it for a college class, or did you pay somebody, a mentor? Did you pay for a course? Did you pay to learn from somebody within your industry?" Because as a business owner, I and Antonio probably can testify to this. We probably spent north of $100,000 to go to the University of Illinois, $150,000 personally. We couldn't deduct a single penny on our tax return. But when you're a business owner and you're reinvesting back into your brand, you're reinvesting back into your education, you're attending conferences, events, those things are deductible. So based on talking with Kevin, he had an extra $10,000 in expenses just because he was investing in himself as a business owner. And if you're a W-2 employee, you don't qualify for that deduction. On top of that, Kevin worked from home. He lived downtown Chicago. He had $2,500 for rent and he worked from home, right? And as a result, he had over $40,000 in home related expenses. Because when you have a business and you work from home, you got two options. Either you get $5 per square footage, or you could say, "Hey, of my home, let's say your home is 1,000 square feet and your home office is 300 square feet. That means 30% of all your home related expenses are deductible on your tax return." So now Kevin having $40,000 in expenses that he was going to pay for no matter what to live downtown Chicago, based on his percentages, he qualified for a $12,000 deduction for his home office expense. And of these expenses up here, I'm not telling him to do anything out of the ordinary. These are all expenses and things that he's paying for already. And then Kevin purchased a car. So when you buy assets within your business and you're reinvesting back into your business, you can get a deduction for auto expenses. So the way it works for auto is either you get 70 cents per mile, 72 and a half cents this year, Or I don't know if you heard about bonus depreciation with the tax changes, but if you purchase a car over 6,000 pounds, that car could be $100,000. You put $10,000 down, you can qualify for a $100,000 deduction in your tax return, regardless of how much you put down. So in Kevin, he wasn't that fancy. He didn't get a $100,000 car. His is more so 50,000, and he only put $10,000 down. But when we did the math, he qualified for a $20,000 deduction. And then we added interest and oil and gas. This man got a $25,000 deduction just because he was a business owner and had a car. And then my favorite is the solo 401k. You see, a lot of times when business owners leave corporate America, we lose out on a lot of benefits. We lose out on health insurance. We lose out on retirement accounts. But I just want to remind you all, as business owners, that you qualify to set up a solo 401k within your business, your own retirement account. And the IRS will allow you to put up to $72,000 into that account. So for Kevin, he was on a salary. We was like, okay, you don't need to put $70,000 into this account, but he put the first $23,000 that he earned into this solo 401k account. Not only did he get a tax deduction for doing so, but he was able to build wealth a lot faster than the average American just because as a business owner, you can reinvest back into your business. So I can go over expenses all day, but big picture here is when you add all of this up, that's $100,000 in expenses. And if he made $100,000, remember as a business owner, you don't get taxed on what you make. You pay taxes on what's left after all your ordinary and necessary expenses to operate your business. So if you made 100K, spent $100,000, well, guess what? Kevin's taxable income was $0, which means he no longer owed $30, 30,000. I wish it was $30. No longer owed 30,000. Kevin's tax bill was zero. So this is just a very, very small example of like how you need to reposition how you think when you have a business. And just remember that keep track of your expenses. You see, a lot of times what happens is, especially as somebody who's done hundreds of tax returns in the last couple of weeks, is that a lot of people will come to me, what's this, April 10th of 2026 and be like, hey, how do I reduce my 2025 tax bill? Well, the year is over. So this is just reminding me that you qualify for a ton of expenses as a business owner. If you understand what I just tried to do is that none of these expenses are things that are out of the ordinary. These are things that everyone is already paying for. But if we don't have the appropriate bookkeeping, we don't have the appropriate CPA or financial advisor on our team to help guide us and navigate us and tell us where to reinvest our money, this won't happen. So this is just my reminder to you all that there's two different tax seasons. Tax prep season is up until April 15th. That's when you give your documents to your accountant and we prep your tax return, literally prep it, and we let you know what you owe. But tax planning season starts today. That's the time when you meet with a qualified financial advisor, qualified CPA, and we help you implement strategic tax strategies throughout the year so you can essentially reduce your tax bill. And now that Kevin doesn't have to pay $30,000 in taxes, that's when I make the introduction to Antonio. So now we can figure out what he can do with that tax savings so he can make build wealth a whole lot faster. So that's just my quick little spill on taxes. Definitely want to open the floor for questions, but wanted to give you all a visual just so you can like see how we kind of think about things so you can reduce your tax bill throughout the year. So if anybody have questions before we pivot to Antonio about business deductions, taxes, definitely gonna open the floor up at the end. And my apologies for my handwriting, but I wanted to give you all a visual instead of me just talking the whole time.
Darren, looks like there's a question Odell asked. Just curious of the auto expenses, can the business rate of a work from home job, would that be cover mileage expenses, travel to those education courses, and buying supplies?
Yep. So you said I'm looking at the question now. So he works from home and he wants to write off mileage. Is that what you're referring to? Odell, you want to hop on? Okay, if not, I can answer. So he says, just curious how the auto expenses can be business related for work from home job. So the way you think about it is if you're working from home, whenever you leave home to go to different type of events, like keep track of your mileage there. I got a lot of realtors I work with. They travel all over the state, all over the city to go to different events. Ed is up in Fort Collins now. He has to drive to Denver and other cities and to meet with clients. So you just want to keep track of those. Anytime you leave in your home to go do something business related, even if you go on a Home Depot or was it Costco to strictly just get printing paper, like I'm keeping track of all of those mileage because that's it's one of the easiest things to prove, but it adds up relatively quickly, especially when you're getting 70 cent or 72 and a half cent per mile. So hopefully that answers. of the question a little
Okay,
bit.
Darian, I have already asked this question of you, but it's a good question.
Hmm.
So, as you well know, we have our main office in Old Town.
Hmm.
But I also have the home office. I take off from work in the morning, come to the home-based office. A, is that tax deductible? And then
Yeah. So
B,
mhm.
when can you tax deduct from the home? Is it only outside office visits or client visits?
Yeah, so if it's a business related commute, the rules can get very technical in terms of like if you technically your home isn't your like primary residence that you work from. But if you're going from one office to another or making runs business related and meeting with clients and taking care of client related activities during that time, that is when I will essentially start the clock in terms of tracking miles.
So
Mm.
to clarify that, if I take
Hmm.
off from home to
Hmm.
come to the office, I cannot deduct the 5 miles for it takes to get here. So I cannot tax deduct that.
So I'm deducting it in my situation. Yes. In your case, I would. It just
Oh,
depends
really?
on the industry too as well. I know doctors, they have like different regulations and different rules, but you as advisor, I don't see why that's not deductible. So it's not
Okay,
like me.
I need to add those to my miles, man.
Yeah, yes, it's the extra every single day, 5 miles, 10 miles
Oh,
round trip. So yeah,
it's a
definitely
tenner,
be covered.
man. It's a 10.
Yeah, yeah. It's a good $7 right there.
Darren, for those people who are not business owners, let's say you have a salary, W-2. Someone asked, what can you do outside of 401k to help you lower your taxes? So what else besides doing a 401k can be helpful for someone who has a salary to reduce your taxes?
Yeah, so you put yourself in a difficult situation in terms of how to reduce your tax bill there, because like you're not really in control of your taxes, since as I mentioned, they take them out before you even get the money. So then it's like, well, where can I reinvest this money so that they can refund me some of the money that I already paid, right? So it's the HSA, the health savings account. It's the IRAs, traditional IRAs, if that's not taken in consideration, the 401k. But I would more so switch my mindset is, okay, I already paid taxes on this money, but how can I not pay taxes on this money again? That's when Antonio comes in and advises where it's okay, I need a Roth IRA instead. So when I retire, I'm not paying taxes on this money again. Or I need to invest in some state bonds so I'm not paying taxes on the interest. But for you, the best routes for you is just figure out what vehicles to invest in that you don't have to pay taxes on. And then trying to itemize on your tax return, donating to charities, purchasing your primary residence so you can write off property taxes, mortgage interest, gambling losses, or things of that nature. But kind of put yourself in a tough situation unless you start investing your money, whether that's real estate or the stock market or even just having a side business outside of
Gotcha.
the
So
basics with HSAs and 401ks.
got it. Okay, helpful.
Hmm.
Helpful. Any
Yep.
other
So,
questions, guys? We have with Darian. He did a great job explaining, it's not
hmm,
what you make, we get taxes, what you earn
yeah,
at the end
pay
of the.
taxes on what's left. Now, one thing I want to mention, and we're going to let Antonio go in and we'll open the floor for questions. Everything I said sounds good. But when it's, and I want to mention this every time, when it's time to start getting funding to purchase real estate or to get assets, or if you're like, hey, I rather not invest all of my money because I want to pay off my debt faster, those are the times where you got to pay taxes. Sometimes you got to pay to play. If you say, hey, I want to get a four flat, I want to start investing in real estate, but I don't want to pay nothing in taxes, all right, unless you're a real estate professional, you're about to get a lot of real estate, you're gonna put yourself in a tough position. But big picture is that some years you do have to show income, so you don't want to get as aggressive with tax write-offs. That's when me and my team comes in because we meet with you quarterly and we let you know based on your goals, how much income do you want to show, how much are we going to pay in estimated taxes, but we make sure you never pay more than your fair share. So I just want to put that on there that living tax free is the game plan. But in years where you know you need to invest, like me, for instance, I don't want to buy property within the next year. I'm showing income on my tax return. So just keep that in mind. So that's pretty much that on that part. So unless nobody got questions on that, Tonio, you can take the floor and then we open the floor back up.
Cool. Sounds
Yeah.
good, brother. All right, I'll share my screen and you let me know as well if you can see my screen as well.
All right, I got you.
Let's see here. There we go. So,
Yep. If it's on the wait for it. Yep, we see you.
okay, cool. Do you see the full screen then?
Yep, full screen.
All right,
Hmm.
perfect. So yeah, to back to Darren's point, what Darren does a great job is talking to clients. All right, you made this much income. This is what you have to not pay in taxes. And my job when I talk to people is, all right, you saved this much money in taxes. How can we take that money that you would have saved in taxes or paid in taxes and take that money to invest towards your future? That's what I do as a financial advisor. So, one thing I hear from my clients is, Antonio, I have questions about debt. I have questions about taxes. I have questions about insurance. I have questions about my trust and will. I have questions about my bank. So what I found with like clients is they're scattered. They go to different people for different questions and different answers. And sometimes they get overwhelmed because they have so many scenarios and they talk to so many people. And what I found at the end of the day, what clients really enjoy is having one person or a team they can go to so they can answer all those questions they have for them and feel confident because most of the clients that I work with are making six figures and seven figures. From a network perspective, they're on track for their goals. But the number one question I hear all the time, Darian, that question is, am I gonna be okay? Across the board. They always ask that question because there can be clients who are putting money in a 401k in a Roth IRA, but half the time is it enough for the future? Should I be doing something else? That's kind of the worry is, am I doing enough or what am I missing I don't have? And so that's where I can come in helping clients how to build their wealth through an actual financial plan. Because anyone can open a Roth IRA or anyone can open an investment account, but it's one thing to have a plan and reach your goals with confidence. So today, as a wealth advisor, we can go over like maybe eight topics of what we do, but I want to keep things simple today, given it's a quick lunch and learn. I want to go over four topics. I want to go over the component of interest, go over estate taxes. I want to go over Roth versus traditional, and then go over the 1099 INT, which people don't know what that means. I'm gonna go into that there. I'm sure you get those come tax season, but a lot of people don't know about this kind of stuff. So I'm gonna walk through those things here. So, a lot of what I do, yes, I help people invest money and plan for the future, but it also, I help people to stop procrastinating. What I mean by that is, when have we heard you should invest money and we hear stories later on the 40 years old? Man, I should have done more. Has anyone heard that story where, hey, my mom told me if she was my age, she should invest at a young age? Has anyone heard stories like that where, hey, I wish I started earlier on? Right. Why do you think that is? Why do you think we know we should invest money or save money, but yet we lag? Why do you think that is?
Not enough information.
Not information. That's right. Right. I'm just joking. I wish I could start it earlier. I wish to too, right? The problem is we don't have enough information where to start, and that's why we push the can down the road. I've seen so many stories where Antonio, I just finished school. Can I invest money after I pay my student debt? You know what? I just got married. Can we save money after we get the home? Hey, until we got a kid on the way, can we save money after we have a kid? So you have all these life stories coming up before you know you're 40 years old and you realize, oh shoot, I don't have the money to save to my name. That's why it's important to start at a young age. So I ran a quick example for you guys. Let's say some young person, 25 years old, they save until the age 60 years old until retirement. Let's say they carve out 300 bucks per paycheck, which is 600 bucks per month. Over the last 30 years, if you invest into an index fund or mutual fund, typically in the SP 500, which is a Fortune 500 company like Google, Facebook, etc., that's an example of it. Over the last 30 years, it's averaged about 10, 12%. But let me play the devil's advocate. Let me just say put 8%. I rather under-promise and over-promise my clients. So let's say you earn an average 8%. Because last year, it was up 19% if you invest in the SP 500. This year alone, I mean, this last 3 months, it's done only 3% or less than 1% the last 3 months. So that's why an average between 8, 12%. So let's say you invest 300 bucks per paycheck. By the time you're 60 years old, that's $1.3 million. Now you might say, Antonio, this sounds cool, but let me get myself together. I'll save money when I'm 35 years old. So now we wait. Let me do this here. Here we go. So let's say we wait 10 years and we start at this 35 years old and we save the same amount, 300 bucks per paycheck, which is 600 bucks per month. Now we have 570 grand. We're both saving the same amount, right? Someone's 25, 600 bucks per month, and someone who's 35, the same amount. You went from having 1.3 to 570 grand. And that's a 10-year difference with that. So one thing I joke about clients is that we all love discounts like Black Friday. Who loves Black Friday or like BOGO, buy one, get one free, 20% discount? Who likes shopping at a discount? Right. I think we all do, right?
Love it.
But we never think about it for your own retirement. You can get a discount on what you can save up the younger you start. So someone who's 25 years old will have way more money saved up than a 35-year-old who's just started with the same amount there. So this is an example of what we do. Obviously, there's way more complex vehicles. So one thing I help clients understand is before we invest your money, we have to help understand what are your goals? What are your short-term goals? What are your midterm goals? What are your long-term goals? When you plan to retire? And the reason I ask these questions is because I truly want to understand what are your intentions with this money, because there's no one size fits all. I can't say, hey, Darian, put your money in your Roth or your problems are solved. That's not the case. I see Darian raising your hand.
Yeah, I got a question. So we're both in the financial industry, and a common thing I have with these tax planning calls and clients is like that mindset shift, especially if you don't come from areas with money or you're just not used to like investing. Like, how do you like speak to your clients and encourage them to like start shifting their mindset so they can like start investing early?
Yeah, that's a great question. And I deal with that because a lot of clients I work with are to your point. I didn't come from much, Darren. We come from it was like what, seven of us live in a two-bedroom house. So I had to go from a scarcity mindset to think I'm never gonna have enough money to like abundant mindset to say, hey, there's more to that. And that takes a lot of, preparation and reading books and talking to the right people that can challenge you to think bigger because oftentimes you only think what you know, but if you talk to someone like Darian, who's a CPA or a consultant that can challenge you to think bigger, it makes you think bigger at that point as well. Because again, I come from a scarcity mindset where you have to save money in the bank, hope for a rainy day fund, and just pray for the best. But we thought about building wealth, but we never thought about transferring wealth to the next generation. That's what I really like to do. Again, my job is to build, sustain, and transfer wealth because anyone can just build wealth, but if you don't know how to transfer that wealth, it can be a big hassle. And I'm gonna explain that here in a second, the next slide, what that looks like. But great question there, Aaron. Great question there. But yeah, I mean, going back to what we help clients understand their goals is because if someone asks me, should I do a Roth IRA investment account? It's like you asking somebody in construction, should I do a hammer or a screwdriver? I'm gonna laugh like, what are you gonna use it for? What's the main purpose? And I'll tell you if a screwdriver or a hammer is gonna be better for you. It's no different than finances. There's Roth IRAs, 401ks, mutual funds, savings accounts, CDs, bonds, corporate bonds. There's a lot of stuff out there, but first understand what are your goals, what are your intentions, how aggressive, how conservative are you? Then we can help you understand how to go about that at that point. Okay. And again, if you guys want a more like one-on-one consultation, I'll be more than happy because it's getting more of a quick recap of what we do as advisors and CPAs. So that's more about component of interest. One thing I want to talk about is estate tax. There, you talked about, federal income tax and state income tax, something you have to pay on your W-2 1099. What a lot of people don't realize is you also have to pay state taxes when you're a certain amount of income of net worth. So the federal is about $15 million for someone individual. If you're married, $30 million. You might say, Antonio, I don't even have $1 million in my name. Why should I worry about this now? So although you might have to worry about state taxes today, which is 40% if your net worth is $15 million, here specifically for Illinois, if you have a 401k, a Roth IRA, or a checking account, or a house, and that's worth more than $150,000, you go to probate court. Has anyone heard through probate court what that means or what that looks like? Okay. Probate court, is that something similar? Yes. Go ahead there. I think you come off the mute there.
Oh yeah, no, I learned about it from you. A lot of
Yeah.
people don't know about it because we think their wills are enough, but once you start
Yeah.
learning about trust and advanced estate planning, like you're saying, that's when probate fees become relevant for a lot of people.
You got it. So I'll give you an example. I'll give you my personal story. So my dad, very humbly came from Mexico, first generation, and all we knew was kind of buy real estate here in the city. So I was very blessed that he was able to buy four properties. I don't know how he did it because he didn't even know English. I'm like, man, if he can buy four properties like with no English, like what am I doing with my life? So my dad was a big role model for me growing up. And so my dad, old school person, bought everything in cash, had rental properties, did a great job building wealth. But one thing we never thought about was transferring wealth. So in Illinois, and again, this varies depending where you live, but here in Illinois, if you pass away and you have a spouse or kids, they'll get 50% automatic because they're beneficiaries. But half of that goes to the state, which means you have to go to court and go to probate court to claim that back. And that can cost you, a lot of money and time. Me personally, it took me about a year and a half to close out my dad's estate, and we had to pay about $42,000 of court fees in order to get those rental properties that belonged to my mom and my siblings, but because we never had a trust to avoid estate issues, we had to go to court fees and have that for yourself. So that's why I told clients it's one thing to build wealth, it's another thing to transfer wealth to the right person and minimize your court fees but also taxes as well. Okay. And just know each state is different in terms of what you had to pay of court fees and taxes. And again, I'm showing Illinois because there's a handful of people living here in Illinois, but here in Illinois, if your net worth more than $4 million, there's difference between federal and state taxes. Same thing with state taxes. And when federally, you have to be net worth more than $50 million, but here in Illinois, you only have to be net worth $4 million in order to pay the state tax. And if you see here in the color, you see the different states that have a lower threshold compared to the federal tax with that. So again, some of the stuff, like Antonio, what the hell this means, don't worry about it. When I first learned about this, I learned through when my dad passed away, and I wish people knew about that at a young age or even before that. So if you ask more questions about that, I'll be more than happy to go one-on-one. But I want to at least bring to your attention when it comes with passing of wealth, it's important to talk to a lawyer and a financial advisor about what's the right trust and the right will to avoid state taxes, but at the same time as well, avoid probate court. Okay.
I'm gonna
So that's
add to
that.
that, Antonio.
What's
Uh,
that?
a lot of times, so we help form LLCs in the Midwest, work with a lot of business owners, and a lot of times they come up to me like, "Hey, I have an LLC," and they assume that that's the entity structure they need to properly transfer wealth and assets to your family. So this is just me saying, adding a snippet where the first thing you want to do is make sure you have a will, but you want to make sure that your trust is what owns all of your LLCs at the end of the day. The LLC alone is for limited liability protection. That gives you the legal protection. So if somebody slip and fall at one of the rental properties or someone sue your business, you're legally protected. But when we're talking about transferring assets from you to your family down the road in generations to come, that's when you need to speak with a estate attorney and
Yep.
Antonio so you can properly set up the structure of your entities in your portfolio so that you can transfer wealth. So LLC alone isn't enough.
You got it, exactly. And this is why the cool thing that's important, Terry, you brought this up earlier. You have to have the right team to in order to be successful. So you need to have a lawyer involved, a financial involved, and a CPA involved, all three together on your team, because that's who's going to help you understand how to build your wealth with that. So what I mean by that is when you have certain amount of net worth, there's strategies like putting money under a trust, gifting to a donation, giving to your family don sponsorship. So there's different things where the CPA has talked to the financial advisor from taxes. And there's different scenarios where the financial advisor has talked to a lawyer about certain rules of a trust. So it's important to have a team. They do the research for you and they talk amongst themselves versus you trying to get one answer from four different people who are in different scenarios at that point there. Yeah, great question there. So another topic besides conflict of interest and estate tax issues, I wanted to go over Roth IRAs. Roth IRAs have been more popular the last couple of years. And the reason why is because it's actually pretty new compared to Social Security and 401ks, etc. So a Roth IRA, it was actually founded in 1998. So literally about 28 years ago, it was founded. Funny enough, it was founded through a senator called William Roth. So William Roth realized, hey, there's a lot of ways that people are building wealth, but there's not a lot of people who are like middle class, who need to get to that limit. So they say, you know what? Let's create an account called a Roth IRA under after my last name. They honor him. And with a Roth IRA, as you may know, it grows tax free. You can withdraw at 60 years old tax free. And the only catch is you have to wait until you're 60 years old, and there's limits where you can put a year. Now, there's some cheat codes that I help clients understand about Roth IRAs. For example, let's say you have a nephew, you have a cousin who's in college. I'll encourage them to open a Roth IRA now. You might say, Antonio, why the hell would you open a Roth IRA? They're still in college. Well, listen to me. Well, hear me out. What I will say to that is, well, if you have a Roth IRA open for 5 years, you can withdraw with no penalty, no taxes from your own Roth IRA and not have to pay taxes and penalty fees $10,000 out for your first home buy, right? This is different if you put money in an investment account or a savings account. There's some tax you have to pay from that. But if you have a Roth IRA open for 5 years, you can withdraw $10,000 tax free, no penalty for a first home buyer. So that's one exception. Another exception a lot of people don't know is you can use a Roth IRA to pay for qualified school expenses. So for me, Darian, we had the benefit of using FAFSA. We didn't come from much, but I know at some point my son will be eligible for FAFSA because we're going to be over the income limit. And you remember in FAFSA, they ask you, what does your mom have in her house? What does she have in her savings account, etc. One thing that FAFSA does not count towards your income is your Roth IRA. So you can have $4 million in a Roth IRA, and they're not going to count that against your FAFSA. So the cool thing about that is that you can withdraw from a Roth IRA to pay for your kids' education, or even go back to your school's education and not have to pay tax and penalty fees for that. Mhm. So that's kind of a little bit more info on the Roth IRA. A lot of people don't know about that. Now, one thing to note is that depending on your income, you may or may not qualify for Roth IRA. So when there's pull limits, that's when you know it's good to be true with that. So again, one caveat is the most you can put if you're under 50 years old is $7,500. And if you're at the age of 50 and above, you can put $8,600. That's number one. Number two, if you make between over 168, the government says, quote unquote, you make too much money. And if you're married, you make over 252, again, quote unquote, you make too much money, you don't qualify for Roth IRA. Now, there's exceptions we can do. There's something called a backdoor Roth IRA. Has anyone heard of that before? A backdoor Roth IRA. Yeah.
Sound like it.
Essentially, what that means is, here's an example of this. Let's say Darren, the IRS told you, hey, you can't deposit money in Chase. Okay, you're gonna say, all right, cool. I won't put money in Chase. But what you're gonna do is you're gonna open a Bank of America account, put money there, and then once you have a Bank of America account, you'll transfer money to Chase. So you didn't directly put money into Chase, you did it through indirectly through a different bank. That's no different than a backdoor Roth IRA. Basically, you put money in a non-deductible traditional IRA, and once the money's there, then you convert it into a Roth IRA so money can grow tax-free. Again, this only makes sense when you're over the income limit of over 252 as a married couple, or if you're under over 168 as a single individual at that point there. Okay.
And one thing to note is this Roth, the IRA stands for individual retirement account. So the
Yep,
strategies
exactly.
that he's talking about right now, you do not need to have a business. These are not business owner strategies. This is strategies for everybody,
Exactly.
regardless of your age. So just keep that in mind.
You got it. Exactly.
Oh, and I put in the chat, this is Portia, sorry. I wanted to know about mega backdoor Roth IRAs. I'm not sure if you guys are discussing those.
Yeah, tell me more about that. I know certain companies do offer that. Has your job offered a mega backdoor?
Oh, I don't know. I work for my, well, I offer, so I, I'm a business owner, I'm an S corp, but I just found out about mega backdoors. So I'm not 100% sure about them, but I think that I can put money into my 401k and transition it to a Roth IRA, but I think it's 36,000. I'm not sure the
Yep.
number. Yeah.
You got it. So a lot of people miss this step. So to your point, the most you can do from an employee side is 24,500 bucks if you're under the age of 50 years old towards your 401k from the employee side of it. But it does not count toward, as your point, you're also not an employee of the business, you're also an employer of the business. So that means for you, you can put up to 70 grand away in your 401k if you wanted to. And we can take to your point, we can take over 30 grand from the traditional and put into the Roth where you can put way more than a Roth IRA because a Roth IRA is only 7,500 bucks. But if you have a mega backdoor Roth IRA, like you pointed out, yeah, we can put over 30 grand with that. Good question. And again, I'll walk through depending on taxes if it makes sense for people because depending on your income threshold, it may make sense or it may not. That's what's important to talk to a CPA about, hey, I'm thinking about doing X, Y, and Z based on my federal tax, my income tax. You suggest do this now or eventually when my income drops. Which brings me to my second point. Um, right now we're talking to a lot of clients about Roth conversions. Okay. This is different from a Roth backdoor IRA. Okay. So what's a Roth IRA conversion? So let me explain why this even a topic now. So let's say you do put money in a 401k, deferred comp, 403b, a pension, annuity. All those great tools will help you not pay taxes, but at some point you have to pay tax on those dollars. So I'll give you a story. I have a client, her name is Lisa. Lisa has about $2.8 million in her 401k. She's super excited about she's gonna be on track for retirement, but I had to break it down to Lisa that hey, that 2.8 is not really your money. You have to pay Uncle Sam a third of that money. So she might be left like maybe 2.1, 2.3 out of the original money she had there. So it's important to have, yes, put money in a 401k, 403bs, 457s, deferred comp, etc. But it's also important to do a Roth. And one thing we're talking to clients now is do Roth conversions. So Roth conversions, basically you take what's already a traditional 401k, traditional IRA, and take that amount and convert it to a Roth. So now you basically pay taxes now for that income, but as the money grows, you don't have to pay taxes in the future. So I'll give an example. Darren, let's say you make 100 grand, and for some reason your business is not doing well. You only made $50,000 this year, so you went from 100 grand to $50,000. So because you're making $50,000 less this year, Darren, that may be a great opportunity. Let's say you have an old 401k from your last company with the Big Four. You have, let's say, 200 grand in your old 401k. Well, let's take 50 grand out of 200 grand and put it towards this tax season. So basically, what I did is last year you made 100 grand from your W-2, but you'll get a W-2 from your $50,000 and you get a 1099-R from the Roth conversion that took from your old 401k. So basically, you're still going to pay the same taxes as last year. We took the opportunity that you're making less money this year, or if the market drops, it's a great way to reduce taxes that way. So another example can be, let's say you have $1 million in a traditional IRA and the market drops to 700 grand, a lot of people might freak out. It's a bad thing their 401ks or IRAs are going down. Yes, it's a bad thing that's going down, but also it's a good way come tax season because now we can take some of that, not all of it, but some of it, and take some of the money that was lost and do the Roth conversion. So there's less money to report than the full balance of $1 million with that. Okay. Any question with that? I know something that's a new topic that people stumble upon on that. There anything you add on to that?
No, when you see the markets drop everything on sale. Everybody said he liked sales a couple minutes ago. So that's how I look at it. That's a good time to move money around.
Yep, you got it. So the other topic I want to go over
I
here.
have a quick question.
Yep.
Hi, my name is Joy. So, um, at my old company that I used to work for back in 2018, they have this rule that they're not going to let us like move our pension over until we're like 64 and a half. So I'm nowhere near that age. But anyway, well, I'm 52. But anyway, so my question to you is that what would be, because I'm trying to figure out, would it be a Roth account? Which Roth account should I roll that over to once I get this pension amount payout? What would your
Yeah.
suggestion be?
So your question is, um, what should I do with the pension amount and what account should I move that money into when I hit the age of 64?
Yes. What is your
Okay.
suggestion?
Yeah. So one thing you can confirm is sometimes you have in-service withdrawal. What that means, Joe, is even though you work for the company at age 55, depending on where you work, you can take that pension 401k and already change that 401k or pension into your own personal IRA at the age of 55. It's called in-service withdrawal. Again, a lot of people don't know about this. You can ask your employers to double check. That's something you look into. On top of that, one thing you can ask as well is depending on annuity or pension is basically an annuity. It's basically saying, hey, they're going to pay you X per month for the next couple of years until you pass away. They're going to pay the same amount per month. And so it's helpful to understand how aggressive they are and how conservative they are to help us determine what's the right vehicle. Let's say you're a person that it's very conservative. You like slow and steady money. I would say, you know what, Joy, there's no really point of taking money that from your pension to an IRA because you're gonna have more upside. Yes, you're gonna make more, but there's more risk that you need to. That can be an example. You might tell me, you know what, Antonio, I'm a very aggressive investor. I'd rather earn 10, 12%. Okay, now at that point, we might discuss different accounts outside of just a pension you can roll over into.
Oh, okay. That's good to know. Thank you.
Yeah, yeah, and again, and we can sit down and kind of walk you through
Hmm.
like what are your goals and your intentions with that. Because
Hmm.
one thing we can do, our clients who are the happiest is when they know they have a steady income coming in every month, no matter what. So you look at
Hmm.
cops, teachers, firefighters. There's actually research on this, guys. They're the most happiest during retirement because they have a steady income coming every 2 weeks out of their pension or their annuity. But let's say you have a 401k, seeing your 401k going from $1 million to 800 grand to 700 grand to 1.3, like it could up and down. It creates a lot of stress, anxiety. So that's what's important when you do retire to have money that's steadily coming in no matter what. Someone that's aggressive and some money that we even see for the next 10 years. That's what's important to have different vehicles for the same reason as well. There's no one size fits all with that. And with that too, Joy, there's different annuities. There's like a variable annuity. There's a fixed pension. There's like an index pension. There's a lot of things you can do out there as well. And one thing you can also ask as well, not sure if you're married or single, you should be asking, do you have a joint or a single pension?
Okay. Thank you.
Okay. What's a joint or single? I'll pick on Darren again this time. So let's say you're a single pension person. The company will say, hey, Darren, we're going to pay you $5,000 per month. But if you pass away, we don't, the $5,000 doesn't go to your mom or your sister. That money only go back to us. A joint pension might say, hey, we won't pay you 5,000 per month, we'll pay you 3,000 per month. But if you pass away, that money will go to your beneficiaries at that point. That's different between a single and a joint pension as well. Okay. Which we can go more in detail to clients based on that. Knowing that we have a couple minutes left, I want to be mindful of time. There's a lot of things you can think depending on what you make a year. Right now, most high yield accounts are going to pay 3.2 of interest, but just being mindful, depending on what you make a year, you might have to pay a good chunk of money federally, almost 37%, or even state 4 points. So you might have to pay almost 40% of taxes when you make over a certain amount of income and a savings account. So although you might earn 3.2 after federal and state income taxes, you might only net about 2% or 1% because you still have to report, you get a 1099 INT, which means not only you have to give Darian your W-2 from your job or 1099, you also give him the 1099 INT that had to show his income. So as financial advisors, we help people understand what are tax efficient vehicles you can use to invest your money. So we talk about, strategic equity investing, muni bonds, permanent life insurance for the right person as well. So we help clients understand more about that as well. So we can go more in details, but I wanted to just go answer in a high level with that. But any questions so far you have for me so far?
Yeah, I know you can spend all day on those things. And we know it's lunchtime and some of you may still be at work. So anybody have like any questions about anything we just talked about or want us to dive deeper on the topic? And I want to add one thing about the Roth IRA. I know we talked about that being an individual account, but business owners keep in mind, and also W-2 employees, that you can talk to your employer to see if some of your contributions can be traditional and some can be Roth, especially if your income is already above that threshold. Like your employer may have the option, even with solo 401ks. I have clients who have those, and their first 20,000 is the Roth and the last 20,000 is the traditional account. So you can kind of create like a hybrid method of both of these, but you just want to keep that in mind that taxes may not be an issue related to retirement now, but starting to work with a lot of retirees and it is you living off a fixed amount per month. And now you also got to give 20, 30% of that to Uncle Sam. Like it's not a good lifestyle. So just keep that in mind. But any questions?
I know you can't really back someone, but what is a good bank or whoever to go to for the IRAs? Fidelity? I'm not sure what you recommend.
Tonio, you want to take that one? I can tell
Yeah,
you what
great
I see
question.
mostly.
So there's a lot of accounts out there. So there's two type of accounts. There's called brokerage account and advisory account. So a brokerage account, this can be like Vanguard, Schwab, Fidelity, Goldman Sachs, even Robinhood can be a broker dealer. And how they make money is they take a small commission or expense ratio to invest your money on your behalf and they invest money on your behalf with that. Now, the cool thing about a brokerage account, you don't really not a lot of money to invest. Now, the only problem is if you want to change investments inside of it or have a more custom-made plan, you really can't because you're only buying what they give you at that point. So, for example, if I go to McDonald's, I can't ask for a Whopper because we know McDonald's doesn't offer Whoppers. They only you kind of get what you get at that point. Now, when you have an advisory account, an advisory, depending on how much you have, now you can put Schwab, Fidelity, Goldman Sachs, BlackRock. You can put all those accounts in one place. You can have an all-star team versus just having one account at that point as well. So again, depending on clients' income and what they plan to put inside of it, that will help me determine if we should do a brokerage account or an advisory account. Because either we have access to both, to all investment companies. It really depends on clients' income and goals with that. Great question.
Yeah. Were you asking which firm recommendations, or you asking like what type of accounts?
Which firms?
Okay,
Like who
gotcha.
to open with?
Yep. So all those ones I said, like, Fidelity, Schwab, Vanguard, anyone can do that with that. So again, you can do it yourself on your account, but again, a lot of clients will have questions like, I open an account, but what am I doing with this? This is where they probably need to find your advisor to do that for themselves as well.
Yeah. Thank you.
Mhm.
Hmm.
And the ones you named are like the main ones I see when I do taxes, like those three.
Yep.
Yeah.
Fidelity, Vanguard, the most popular ones I see as well. Yeah.
Hmm.
And Wealthfront too.
Yep, Charles Schwab. List goes on. Just want to work with a reputable firm. So, especially you putting hundreds of $1,000s in there. I'm not going to no credit union or small bank that doesn't have a bunch of money in the reserves to cover what I'm putting in there. So just keep that in mind. But we can answer that if you got more questions about recommendations once you start deciding where to go. But any more questions? I know me and Antonio, well, for starters, just in case y'all start heading out, we appreciate all of y'all for joining today. I know it's lunchtime and it's also Friday, but we just want to revisit taxes and wealth building early in the year, especially while some of you have to pay a gigantic tax bills or smaller tax bills, just to give you an opportunity to ask questions. And feel free to use us as a resource throughout the year. I'll email you all our information just so you can have it. Feel free to join future webinars and just use us as a resource. So, Antonio, anything to add before we kind of close out, unless someone has questions?
No, I think it was great to speak with people. To your point, it's one thing to, oh, this sounds pretty cool. I want to learn more about it. It's one thing to learn. It's one thing to implement. So if you have any questions, reach out to Darian about any questions about taxes and investments, because it's one thing to learn, nothing to implement. So definitely implement anything you saw, at least one takeaway to implement today as well.
Yeah, and this phase outs to everything we just said. Even with these one big beautiful tax bill things, a lot of people has been misled about the no tax on tips, no tax on overtime, the senior deductions, QB. There's phase outs to literally 99% of the things we just said. So you may see somebody on the social media or telling you a cute little strategy, or you can write off $10,000 in car insurance. Well, if you make less than 100,000, or you can contribute to a Roth if you make less than 150. But for some of you, you at that point where those smaller strategies or your income is way beyond that limit. That's when it's very, very, very important for you to reach out to us. And just any strategy you see, look up phase outs because you may not be eligible, but there's a lot of backdoor methods. There's a lot of loopholes and opportunities for you to take advantage of the tax code. But the biggest tax we pay is the tax of not knowing. So if you're not continuously educating yourself about these things and having professionals in your corner that can help, ultimately, I want to say setting yourself up for failure, but you're overpaying in taxes over and over
Yep.
again. So that's my spiel. But that is it. I know it's tax time, so I got a last minute call. So you know how that goes before April 15th. But if anybody hasn't filed, file an extension, get that taken care of, and feel free to reach out to us if you need anything.
Cool.
So y'all take care.
Thank you guys.
Thanks.
No problem.